Welcome back to DrBlazeFx. Today you will learn about the truth about liquidity and how smart money hunts your stop loss. Follow carefully. Every time you take a trade, someone else takes the opposite side. And if you've ever wondered why your stop loss gets hit just before price moves in your direction, this is the truth behind it. Today, I'll reveal how smart money hunts liquidity, how institutions trap retail traders, and how you can turn their strategy against them. I'll take you deep into how banks and institutions think, how they manipulate price, and how you can start trading like them, not against them. Liquidity is the fuel of the market. It's not random volatility. It's the reason price moves, the hidden energy source behind every candle you see. In simple terms, liquidity means available money, orders sitting in the market waiting to be triggered. But not all liquidity is equal. There's buy-side liquidity above recent highs and sell-side liquidity below recent lows. Smart money knows where these orders are. They see what most retail traders cannot. When you set a stop loss, you're essentially leaving behind a price tag that says, there's money here. And institutions with their massive orders need that liquidity to fill their trades. Let's imagine the market as a giant ocean. Retail traders are small boats moving with emotion, chasing waves. Smart money are the tides. They create the waves. When you see price shooting up, it's not just buying pressure. It's often smart money reaching for liquidity, grabbing stop losses and pending orders. They need those stop orders to provide the opposite side of their trade. So, when you're buying a breakout, they're selling into your enthusiasm. When you're panicking and closing a loss, they're buying from your fear. Let's break down the 4 stages of liquidity movement. Stage 1, accumulation. Price moves sideways. Retail traders get bored, but this is where liquidity builds up. Equal highs and lows. Trapped orders waiting to be hunted. Stage 2, manipulation or the sweep. Smart money drives price above or below these key levels to trigger stop losses. They grab liquidity, fill their large positions, and leave behind long wicks. Stage 3, expansion. Once liquidity is collected, the real move begins. Strong displacement candles appear, showing the true intent of institutional money. Stage 4, reaccumulation or distribution. After the expansion, the market slows again, building new liquidity pools for the next cycle. This cycle repeats endlessly, day after day, session after session. Now, let's talk about the psychology behind liquidity. Markets are designed to move from liquidity to liquidity. This means price moves from areas where traders are trapped to areas where new liquidity sits. Retail traders are taught to buy support and sell resistance. But smart money uses those same levels as hunting grounds. Think about it. If millions of traders are buying support, where do their stop losses sit? Below support. That's where smart money drives price first, to trigger those stops, and then the market reverses upward. That's the trap. The illusion of breakout and breakdown. It's not chaos. It's design. Let's visualize this with a classic example. Price is moving within a range. Retail traders mark the resistance at the top and the support at the bottom. Price pushes slightly above the resistance. Breakout traders buy. Smart money sells into that liquidity, drives price down, and sweeps all the stops below the range. Once both sides are cleaned out, the real move starts, opposite of what the crowd expected. That single sweep creates the energy for a true market direction. Liquidity isn't just about stop hunts. It's also about order blocks, imbalances, and fair value gaps, zones that smart money uses to manage trades. After sweeping liquidity, price often returns to rebalance an imbalance or test an order block. That's where smart traders enter. An order block is the last opposite candle before a strong move, where institutions place their positions. A fair value gap is a sudden imbalance in price action, a sign that orders weren't fully matched. When price retraces to these zones after grabbing liquidity, it's an opportunity to enter with precision. Now, let's talk about smart money intent. Institutions don't just enter trades randomly. They look for areas with high liquidity concentration. That's where they can buy or sell large volumes without causing huge slippage. So, when you see price stall around a key level, it's not indecision. It's accumulation. They're loading up positions while retail traders are guessing direction. Once they're done accumulating, They'll sweep nearby liquidity and push price strongly, leaving retail traders behind. Here's a critical truth. Smart money doesn't hunt your stop loss out of spite. They hunt it out of necessity. They can't fill multi-million-dollar positions in thin liquidity areas. They must create movement, fake momentum, and trigger retail orders to get filled. That's why understanding liquidity is like learning the hidden language of price. Once you understand it, you stop fearing stop hunts. You start expecting them. Now, let's move into how to trade with liquidity, not against it. Mark obvious highs and lows. Those are liquidity pools. Wait for a sweep. When price spikes above a high or below a low, pay attention. Watch for structure shift. A strong displacement candle confirms the sweep. Wait for retracement. Price often pulls back to a fair value gap or breaker block. Enter in the direction of displacement, not in the direction of the sweep. This is how you flip the game, from being hunted to being a hunter. Let's talk about liquidity traps in different time frames. On higher time frames, like 4H or daily, liquidity shows institutional intent. Sweeps there can lead to long-term reversals. On lower time frames, like 1M or 5M, liquidity grabs happen often. They're used to fill intraday orders. So, align your trades with higher time frame liquidity. Don't fight the bigger picture. Follow where the bigger money is hunting. Now, here's something most traders ignore. Session-based liquidity sweeps. The London session often sweeps Asia's liquidity. The New York session often sweeps London's liquidity. Understanding this flow gives you a powerful edge. Instead of trading every candle, wait for those session sweeps. They often mark the beginning of the real move of the day. Let's also talk about liquidity voids. Areas where price moved too fast, leaving gaps in structure. These voids act like magnets. Price tends to return there to fill in missing orders. When you see a void align with liquidity above or below, that's a strong confluence zone. Smart traders look for entries in those areas after a sweep and confirmation. One of the biggest mistakes retail traders make is placing stops too close to structure. Smart money knows the average stop distance. If your stop is just below a recent low, it's like leaving your wallet in plain sight. The solution? Place stops beyond liquidity zones or use structure-based invalidation, not emotion-based fear. Trade what you see, not what you feel. Let's bring it all together with a real example. You identify equal lows, that's sell-side liquidity. Price sweeps below those lows, leaves a sharp rejection wick, and forms a bullish displacement. It retraces into a fair value gap. You buy there. Stop loss goes below the sweep. Take profit targets the opposite liquidity. The equal highs, that's a full smart money liquidity-based setup. Simple, logical, and precise. Liquidity is a manipulation. It's market structure in motion. Every spike, every fake out, every trap is engineered for one reason: to find liquidity. The more you understand it, the more confident you become. You'll stop chasing price and start following purpose. Remember, price doesn't move randomly. Smart money moves price toward liquidity. Once liquidity is collected, price moves away. That's your opportunity. So, next time your stop loss gets hit, don't be frustrated. Ask yourself, was that a liquidity sweep? If yes, you've just been shown where the real move begins. Now, you're equipped to spot it, trade it, and profit from it. You now understand the truth about liquidity, how smart money hunts your stop loss, and how you can flip the game to your advantage. If you found value in this, remember, you're either the liquidity or you're the one collecting it. Trade smart, trade patient, and think like the institutions. Because once you understand liquidity, you'll never see the market the same way again. For more educated, productive, and insightful video that will improve your trading strategies and skill, subscribe, like, and drop a comment. Bye for now.